Hello and welcome to episode 2 in the option series. If you haven't seen the first episode, you can find it on the channel, where I cover the basic concept of an option. This video is going to focus on what impacts the value of an option, including what the terms in, out and at the money mean. So let's get going. We first look on how the option value changes over time. We will use a hypothetical option on a barrel of oil. We will stick to the following credentials: a European call option with a strike price of $90 that expires in exactly 1 year. Oil is currently trading at $85. At the time of purchase, the option is valued at $2. Therefore, the option buyer will have an opportunity, but not an obligation, to purchase a barrel of oil for $90 exactly 1 year in the future. Now let's take a look at what could happen in the next year. If we wait 3 months, the price of oil can change. In this case, a barrel of oil now trades at $94. As the strike price is $90, if you could execute the option today, you will make $4. In this case, the option is said to be in the money, as the option is in a profitable position if you could execute it on the day. The value most likely would have increased from the price of $2, which it was originally bought for. If we now wait another 3 months, the price of oil has now dropped to $77. As this is below the strike price of $90, the option is now said to be out of the money. Likewise, the value of the option would have dropped from the $2 that it was originally purchased for. Finally, when the price of the underlying equals the strike price, the option is said to be at the money. It is worth noting, if it was a put rather than a call option, then the positions when the option is in and out of the money would reverse. As we have discussed, an individual is not going to give an option to someone for free, and therefore there is a price or value associated with an option. We will run through 6 of the key factors that impacts the value of an option. Firstly, we start off with the current price and strike price of the asset. Let's take a European call option as an example, which gives the option holder an opportunity to buy the asset at the strike price at expiry. Now, the larger the difference in price in the positive direction between the asset and the strike price at expiry, the more profit the option holder can make. So therefore, the value of the option will be significantly impacted by the difference in the asset price and strike price during the time the contract is active. The next factor relates to time to expiry. Generally, the longer the time to expiry, the more value the option has. But why is this? If we take a European call option that expires in 1 month, then there is a significant shorter time for the price to move when compared to an option that expires in 1 year. Given that there will be more uncertainty on the asset price in 1 year compared to 1 month, the time to expiry will impact the value of the option. The fourth factor is the risk-free rate, which may raise an eyebrow on why this has an impact on the value of an option. The definition of the risk-free rate, according to Investopedia.com, is the theoretical rate of return that an investor would expect on an investment with zero risk. This is usually assumed to be the current interest on government debt in an economically developed country, such as the US or the United Kingdom. But why is this important? Let's run through an example. Say you have $100 and you could either invest at the risk-free rate or buy an option. If the risk-free rate is 5%, then you can make $5 of profit if you invest at the risk-free rate during the year. Now, if you buy an option, the expected profit you make needs to be equal or larger to $5. Otherwise, it's better to invest at the risk-free rate. Therefore, as the risk-free rate increases, the benefits to the option buyer has to also increase. Next is the volatility of the underlying asset. But what is volatility? Volatility is the level that the price of an asset fluctuates over a specific time period. Let's take an asset with low volatility and an asset with high volatility and see the price at expiry. It can be seen that the high volatility asset price fluctuates more, and the price when the option expires is much larger. In this example, the price in the high volatility asset is $8 larger than the low volatility asset. Therefore, highly volatile assets have more uncertainty on the final price of the assets when the option is exercised, increasing the value of an option. Finally, the benefit and costs of holding the underlying asset needs to be considered. If you buy a barrel of oil today, but only require it in 1 year, then you will need to pay for the storage of the barrel. Likewise, if you have an option on a government bond, then you won't benefit from the coupon payments until you exercise the option. So these factors relating to the asset will impact the value of the option. Thank you for watching this episode, and I hope you now have a greater understanding on the key factors that impact the value of an option. Feel free to watch any other episodes in the series, but it's bye for now.